I was sitting with a client last week, and when we do our second opinion reviews, one of the first things we do is we analyze the portfolio. Besides taxes and asset protection and estate planning and things that we do as well to advise our clients, which we're one of the few firms that does that. And on top of that, we're a fiduciary, which means we have to put your interests ahead of our own. It's the highest level of standard of care there is in the industry, as opposed to a broker that has the suitability standard. So we have the highest standard of care that you can have, and so we're probably the best folks to go to relative to getting a second opinion, because we put your interest ahead of our own, and we're proud of that. And we're going to give you the most, straight advice you could get. But I was talking with this client and last week, and we were reviewing their portfolio. Actually, a prospective client that's become a client, and we were reviewing their portfolio, and they were conservative, they felt. And when we did the analysis, they had a projected loss in the next crisis here. We have some pretty unique software that will measure the future volatility of a portfolio based upon historic numbers. And if we had another 2008 again, they would lose about 42% of their assets, and they have about $2 million. That's $800,000 loss. And I don't know about you, but that hurts. So if you have $1 million, talking about a $400,000 loss, and most of the portfolios I review are somewhere between high 20s at a minimum to really averages around mid 30s. So when you get into retirement, that's just unacceptable. Not even close. We can't afford to do that. And I always use the Warren Buffett quote, and this is kind of the DNA of our family and our family of clients and our company is rule number one, don't lose money. And rule number two, don't forget about rule number one by Warren Buffett. And we have to explain what this means. We have bear markets that we've had have been significant from 1990 or from 1929 to 1932. The market lost 87%. Big number. That was the beginning of the Great Depression. And of course, in 2008 and 9, we lost about 57%. And then between 2000 and 2002, we lost over 40%, and the NASDAQ lost a unbelievable 78%. 78%. That was all those stocks like Yahoo and Google and Amazon when they came out, and they had ridiculous price to earnings ratios like 100 plus. And so, that's very a painful event. And I showed this chart in the workshop that I gave last week, and I wish you could see it. And actually, I'm figuring out a way to video all of my radio shows, because I think a picture tells 1,000 words, and I'm going to try to incorporate some charts in that for the people that view it, so it's a little extra bonus for you. But I wish you could see this chart, and it's an S&P 500 chart back to 1997. And again, I showed this in my workshop. It was very powerful, because most of you have never seen this chart before. And it goes back 17 years, almost 18 years. And in 1997, the S&P 500 was at 741. It rose all the way up to 2000, in 2000 to 1571. Well, guess what happened down in 2002, 2003? Market corrected 50%, was down to, guess what, same number, 777. So in 1997, it was at 741, the S&P. Then it fell back down in 2003 to 771. Then we had a great rocket ship up of 100%, back down again at 57%. In 2009, the market bottomed at, guess what, 700. So 3 times in the last 17 years, we've had the S&P 500 retraced to where it was in 1997. How crazy is that? Meaning, if you had invested money in 1997, okay, you were still you had made no money through 2009. Crazy. And if you invested in 2000 at the peak, it took you till 2013 to break even, 13 years to get your money back. So minus inflation, that's about 30% loss, because about 3% average inflation rate. So my point is that how do we protect against what's going on in the economy? And we have so many things that are headwinds right now. We've got China, which has been down over 40% their stock market. Commodities have gotten destroyed. Oil down over 50% from its highs. Gold's now down 45% from its 2011 highs. Big deal. These are things that happen in rough markets. And our market's really been unscathed, even though we're down from the peak around 10%. I mean, we could theoretically, we've had two 50% drawdowns or losses in this last decade. If we had another 50% loss, which is nothing out of the norm, you'd be at S&P 1000. You'd be at Dow. You'd be at Dow about from here about 6,000, 7,000. Dow's at over 13,000. So pretty significant losses that are just part of the normal course of the last 15 years. And this chart shows that. So the question becomes, how do we protect against downside risk? How do we protect real risk? The first way to do that, and I talk about this in my workshop, is annuities. And we are a fiduciary. We don't sell annuities. We use them as an asset class. Big difference. A lot of people sell annuities, and it's kind of the hammer and the nail. An annuity solves every problem. No, it does not. It solves certain problems, and you got to be very careful and precise with the use of annuities. But annuities is the only way to absolute guarantee risk based upon the claims paying ability of the insurance company, and we're talking about fixed index annuities. Variable annuities have no principal protection, and most people don't know that. So you want a fixed index annuity, which will give you some buffer against downside risk and participation on the upside. So annuities are a really great tool, but you've got to be able to use them properly. Now, one of the things I love is the 4% rule. The 4% rule says that that's how much money you could take out, 4% of your portfolio, if with inflation and taxes, for you to have your money last the rest of your life. Now, the problem with this is that the 4% rule doesn't work anymore. Morningstar says that the average retiree can take out less than 2% of their portfolio. I think I apologize, a little over 2%. He said, David, well, that doesn't work. If I have $1 million, I can take out $20,000 a year. Well, that's not enough money. One of the best ways to protect your portfolio and to create an income stream that you won't outlive is annuities as a replacement for bonds. In a Wall Street Journal article that I used the other day, basically, if you replace, they interviewed a very well-respected financial advisor. And it's something we've known for a long time. If most of you have a 60-40 portfolio, if you had invested in 2000 with a 60% bond, 60% stock, 40% bond portfolio, we would only have a success rate of 29%. 29%. If we had a 50% stock, 50% annuity portfolio, we have over a 90% success rate. So if you're going to, one of the simplest ways to reduce risk is replace your bond portfolio with a annuity portfolio. Real simple, because would you rather get a rate of return of, let's say, 2% over your lifetime, or have an income stream for the rest of your life and your spouse's life over 5 to 6%, and never worrying about running out of money? Now, we don't want to put all our money in annuities, but we want to use it precisely so it's a proxy for bonds. In fact, in this article, it says there's no need for retirees to hold bonds. Instead, annuities with the promise of income for life act as super bonds. Now, I don't know if they're super bonds, but I will tell you that they are a great proxy or replacement and a better alternative mathematically for your retirement than bonds. Now, we'll use bonds once in a while tactically to reduce risk in the short term, but we're not a long-term holder of bonds. We believe they're a poor asset class and will not allow you to have the distribution rates that our clients get, which is in the 4, 5 to 6% range. So if you want to learn how to double your income, potentially double your income, and reduce the risk of your portfolio, give me a call at 1-800-611-1967. That's 1-800-611-1967, or go to reyesplan.com. That's REYES plan.com. That's reyesplan.com. So, again, we're going to have this workshop that I really want you to attend. Again, it's called The Essential Financial Strategies for the New Economy, the New Normal Economy. And we had a great turnout last time. We can only hold 50 people, like 20 families plus. And last time we did this, we had 170 requests. So I'd advise you to call me about this. And we're going to have this on the 27th of October. And it's going to be at Ruth Chris in Carmel Valley. Great place. They have a great room for talks and for food and unbelievable steaks and chicken and all the things they had. So if you want to attend that workshop, give us a call immediately to get reserved for that. We request you have at least $500,000 plus in assets, because this workshop is geared for clients that have those type of assets. so we can help you the best. We'll have other workshops that are for really everybody, but this one is specially designed for clients that have tax issues, that have estate planning concerns, and have investment issues that they want to make sure that they're protected. So again, if you want to attend and you fit that criteria, give us a call at 1-800-611-1967. That's 1-800-611-1967, or go to reyesplan.com. That's REYES plan.com. So we're running out of time here in this segment. We'll be back and continue our talk about managing downside risk in these volatile markets. This is David Reyes, AM 760, KFMB.
A well-designed, tax-free retirement. And you can have it.
How come I didn't find out about this before?
The retirement architect, David Reyes, will continue next.